Hi everyone. Today we are going to discuss about very important aspect in mutual funds, that is tracking error. What is tracking error? Its importance in mutual funds. Yes, it is very important in mutual funds. Before we are going to invest in mutual funds, the very first thing we need to check about the tracking error, isn't it? Because it affects the performance, the returns of that mutual funds, isn't it? First of all, what is tracking error? Tracking error is a measure of how closely a mutual fund's performance tracks its benchmark index. That means how closely is aligning its benchmark index, how closely is following its benchmark index, whether it is going at par with benchmark index or not. It is going in parallel with the benchmark index or not, or it is going away with the benchmark index. That means who will tell? The tracking error will tell, isn't it? By looking at the tracking error, we can know that we will understand whether that particular mutual fund scheme is following its benchmark index or not. Okay, how it is calculated? It is calculated using the formula of standard deviation of the tracking error difference between the mutual funds returns and the benchmark index returns. Okay, guys. Okay, now let us see an example. Here is a table showing the tracking error of various mutual fund schemes. Yes, there are 5 mutual fund schemes in Nifty 50 index. That means these 5 are the 50 Nifty 50 index funds. Okay, now you can see on the screen the tracking errors given. These are okay, not very high. These are very closely aligning with the Nifty 50 index. As you can see from the table, the tracking error of all these mutual funds is relatively low. This indicates their performance is closely aligned with the Nifty 50 index. Okay, guys, that means a low tracking error means that the index fund has been consistent in the following its benchmark. A high tracking error means that the index fund has been volatile and unpredictable in its performance. That means we must choose a mutual fund scheme with low tracking error. Therefore, a low tracking error mutual fund scheme is very consistent than high tracking error mutual fund scheme. You have understood, I think. Okay, guys. Okay. Why? What are the reasons for this tracking error? There are several factors that can affect the tracking error in an index fund. Okay. Okay. First one, fees and expenses. Yeah, an index fund has to pay fees and expenses to manage its portfolio, such as brokerage charges, transaction costs, audit fee, blah, blah, blah. These fees and expenses and other charges can reduce the returns of that index fund, isn't it, guys? Yes. And create a track on its performance. That means fees and expenses can affect the returns of that index fund. Therefore, these can cause the tracking error of that mutual fund. Okay, guys. Next one, cash holdings. An index fund may hold some cash in its portfolio for liquidity purposes, such as meeting redemption requests from the investors or rebalancing its portfolio. Okay. However, cash does not any return and may even lose its value due to inflation. This creates a mismatch between the returns of the index fund and its benchmark. That means cash holdings can cause the tracking error of the mutual fund scheme. Okay, guys. Next one, rebalancing frequency. That means an index fund has to rebalance its portfolio periodically to match any changes in its benchmark composition or weightage. For example, if a stock is added in a Nifty 50 index, then it has to adjust its portfolio accordingly. However, rebalancing involves buying and selling stocks which can incur costs of taxes. Then therefore, that can cause tracking error of that mutual fund scheme. That means these are a few factors that can affect the tracking error of that mutual fund scheme. That means a low tracking error indicates the efficient of that efficient the mutual fund scheme is. For example, a mutual fund scheme with 1.5 tracking error. That means it is more consistent and efficient in terms of returns compared with this benchmark index rather than other mutual fund schemes which are having high tracking error. That means you have understood so far. I think thank you guys. We have come across this tracking error of a mutual fund scheme and how it is efficient. That means how we have to look into when we choose a mutual fund scheme before we are going to invest. That means we always prefer mutual fund schemes with a low tracking error. Then likewise, thank you guys. Thank you. Signing off.